If you're looking for a 10-bagger or the next Naspers, then small cap investing might be for you. And when we're talking about small caps, there's a Coca-Cola one, there's one from a bottle of water, and that's from somewhere nondescript. We're not talking about these kinds of small caps. That's a waste of time. This is Tonight. I'm Bruce Whitfield. We're not talking about those kind of small caps. We're talking about small shares that one day could be big shares. Keith McLachlan is a fund manager at Alpha Wealth. Firstly, 10-baggers. Educate us on what it means to have a 10-bagger.
Simply, it's a share you bought that goes up tenfold, so you make 10 times your money on that, i.e. a great investment.
Okay, so into that category would fall companies like Naspers, famous brands in recent years. What else?
Aspen, basically all large companies started off small. So work your way through the top 40, arguably like any one of them somewhere back then was a small cap.
Not all small companies become big though. And that's always the risk, isn't it?
Definitely.
We look back at history, we say Pick n Pay was once 4 shops, and look at it today. And Woolies was once 1 shop in Adelaide Street in Cape Town. Look at it today. But along the way, many have come and gone, probably far more than has succeeded.
Yeah, there's definitely, it's what they call survivorship bias in the indices. Survivorship bias is the indices tend to be built up with the companies that still survive. And all the other ones fall out of the index because they go bankrupt, etc., etc. But there's 2 things to bear in mind when thinking about 10-baggers. Yes, most of the large companies started off as small companies, and that's where they come from. But over what time period?
Yes.
And obviously, with an investment, time value of money is important. You want that company to grow its trajectory to be as sharp as possible.
You want the company to be doubling in size every 5 years, roughly.
Preferably every day.
No, but realistically,
yes.
I mean, if you get a compounded growth of 15% a year,
yeah.
The company's going to double in value every 5 years or so. Now, with 10-baggers, though, the rule seems to be slightly different. It's kind of, they tend to grow much faster. EOH, for example,
yes.
has had a huge stratospheric growth trajectory. Those are the sorts of shares we want. We want to get those 10 times returns perhaps in 10 years.
Definitely. There's a couple of other examples which are still arguably in growth phase. I mean, there's famous brands, EOHs in the tech sector. Most people know famous brands because they interact with the Steers brands and Debonair's brands all the time. But definitely, you want that growth as quick as possible. Also, consistency would be nice. A stock that doubles 1 year and halves the next year is perhaps not the story you're looking for.
Okay, so you've got 3 that you've chosen for us in terms of the ones that you believe are 10-baggers. What are your time frames for this? 100 years is not an answer.
Well, my time frame is really 5 years.
So you believe these 3 shares within 5 years will give us 10 times our money. If we put $10 in today, we'll get $100 in within 5 years.
That would be nice. But also, let's not get anchored on this holy grail of 10-baggers. Even if you get a 9-bagger,
I'll take 9.
I'll take 9. I'll take 8. There's no special recipe to selecting these sort of stocks other than all the classic ones. Look for really high-quality companies that are growing quickly and are undervalued by the market. And if you and the more you have of all of those metrics, the better investment will likely be, whether it's a 10-bagger or a 20-bagger or a 5-bagger or.
Okay, why do you believe that Santova is a high growth, cheap enough, exciting opportunity for the next 5 years?
Well, first of all, let's touch on the business model. Santova is a non-asset-based supply chain manager.
In English.
What that means is you can outsource your supply chain to Santova and more importantly, internationally. So they can import, export, source goods, clear and freight them, ship them across, all the way where you perhaps don't even touch them and they rock up on your customer's door. And in order to do this, because it's a huge volume business, but low margin, they built a system called Oscar. Oscar plugs.
Boy, do they regret that now.
But Oscar plugs into clients' systems, and it's largely paperless and automated and the like. And it's incredibly scalable. So the value of that system is sort of approximating, my guess is approximating the fair value of Santova itself. So ignoring that, you're buying a business, buying the system at this price, but actually getting the business free. Then the business itself is relatively small, so it can gain market share in this sort of market, irrespective of what the economy is doing, and still grow quite aggressively. And it can do this not just by gaining more clients in the local market, but by replicating and expanding its trade routes. For example, it bought in the UK the other day. And by doing that, it could always import and export from the UK, but now it captures a full another leg of that. And if you buy reasonable multiple, so it's an incredibly scalable, expandable business with global potential. And actually at this point, they're managing to earn half their revenue from offshore operations.
Which is, I mean, the trend for South African companies, especially larger companies, is to offshore as much of those earnings as they possibly can. It's a nice rand hedge. Yeah. Interesting story. Santova, what about Calgro? These are guys who build cheap houses, don't they?
Well, the way I prefer to phrase it is they do integrated housing developments. So let's ignore that business model for a moment and ignore the construction industry in South Africa and consider what housing is. If you know Maslow's hierarchy of needs, on the bottom rung is shelter. So it's actually a very, very inelastic good that these guys are producing within Calgro. The question is, it's also lumpy and risky and capital intense, and depending on how you structure it. And something that differentiates Calgro from the rest of their competitors is that they have a risk-based approach to managing the business. For example, they won't build a house until they've sold it. They often bring in key partners like government and et cetera, because and then you don't focus on any single type of house. You actually have a spectrum of houses from all the way low end of RDP all the way up to high end. Yeah. So depending on which part of the market is happening, you can focus on building and selling those houses. And then of course you zoom out and they've actually got a whole range of projects and a whole range of geographies across South Africa. So if one area is going badly or one project stumbles, you've got all the rest. So it's providing a very inelastic product. Housing, shelter.
When you look at South Africa, the most basic need in South Africa is for accommodation. Absolutely. It is for housing. It's also for decent housing, quality housing, to give people, one, an asset of value with which to trade into the future, and two, dignity, of course.
Absolutely. And if you can get around all the risks and hurdles and complications in doing this, the market is almost infinite.
Okay. All right, so Calgro is there. You're a fan of Adept IT, but I'm guessing that Adept IT has had a jolly good run recently. It probably no longer ticks the value box.
Well, I actually feel it's fairly valued, give or take, in my opinion. But at this point, it's not a comment on the quality of the company, it's more a comment on the valuation thereon.
Then you have to replace it with something else. What will you replace it with?
Well, exactly. In the stock market, there's always opportunity cost. So if there's a equal quality company but at a better price, one should argue to go for that. And at this point, we've got Rolfs. Now, Rolfs is really a diversified chemicals company. And that sector has been particularly hard hit. If you look at Omnia as a key example, its share price has done horrendously over the last year. Its results coming out have been soft, and there's all sorts of problems. And you get this brush, like the entire sector painted with the same brush. Rolfs is actually a very, very different business. And at this point, you can buy it on the 9 times price earnings.
So you buy Sasol on that as well. Why would you not buy Sasol rather than Rolfs?
Sasol is really a commodity company at the heart of it.
Half of it's chemicals, though.
Absolutely. But that half of it that's chemicals, the other half of it is actually the swing factor on where profits go. Rolfs, on the other hand, you see, Omnia got originally hit and it's been decimated because it sells into the mining sector, particularly the part of the business that splits into fertilizers and explosives. Rolfs doesn't service that. Rolfs services the water, agricultural market. It does sell into mining and industrial, but not explosive, not those aspects of chemicals. And then Rolfs has a pigment segment that's quite interesting, and a silica aspect to it, and it's ramping up its export growth. In a nutshell, so looking at the differences, which is always, people go, well, how can they do better than those ones? Ignoring those, it's just the valuation that's so compelling in Rolfs as well.
Okay. Now, all right, so Rolfs, you've given us 3. You've given us Santova, Calgro, and Rolfs. Why would we buy these 3 individual counters rather than give our money to a small cap fund manager to take the risk out, to sort of de-risk ourselves and protect ourselves from ourselves?
You are aware I'm a small cap fund manager.
You are. So why would you have me buy these three rather than your fund?
Okay, so there's pros and cons. There's pros and cons. Obviously, these are small companies. That makes their shares relatively illiquid. For large funds, you have to build a meaningful position that moves the needle when the share price does well. These companies would probably not be able to, their share price would not be able to absorb that amount of buying. Yet on the retail market, an individual investor buying, $1,000, 10 grand, 100 grand worth of the script shouldn't move the market too much. So you have much more nimble liquidity requirements.
But I need you as the fund manager, though, to buy these shares at some point. Now, do I have to buy these shares and sit on them until the companies grow to a point where they're big enough for fund managers to take a position in them, to drive the share price up, to give me the opportunity to exit at some point in the future?
That's part of the argument, actually, for small caps, is you get these key stages in a small cap life. Ignoring the fundamentals of the company growing, we're actually talking literally the share price life, where in South Africa, the key benchmark is about 2 billion. Because below 2 billion, fund managers cannot hold more than 5% of it. Above 2 billion, you can suddenly hold up to 10%, and it's just a line in the sand. That's the way it is. So you tend to find companies below a market cap of $1 billion are almost in no funds. The moment they hit $1 billion, they start to pop up on a lot of radars. Have a look at EOH. Bruce brought it up earlier as an example. EOH took about 10 years to get to $1 billion market cap. It took about 1 year to get to $2 billion. And then it took about 1 year to get to 4 and 5.
But that's the point. You're buying this, if you've got kids being born today and you're buying it for the senior school and university education, not for junior school education.
Definitely. These are not trades. These are buying, put in the bottom drawer and forget about it. Revisit that in 5 years' time.
Okay. There we go. Keith McLachlan, nice to see you. Thank you very much for that. Keith McLachlan, fund manager at Alpha Wealth, with some really good insights as to why you buy small caps, how you should treat small caps as well. And those three small caps that came up on his radar this evening, Santova, Calgro, and Rolfs. Those are the three small caps. Thank you for watching. There'll be more big gains, we hope, to be made over the next 10 years. But we'll do it tomorrow as well. Till then, good night and goodbye.